So in terms of Labour's return to power and how that's going to impact pensions, I think there are really two main areas. There is the state pension side of things, and then there's private or company and public sector pensions. And on the state pension side, Labour have been at pains to say that they will preserve the triple lock. Most people will be familiar with this, and it's a commitment broadly to increasing state pensions by a minimum level each year. That's increasingly becoming very expensive. It does remain to be seen whether that's going to be a long-term policy, as it will become more challenging. On the private funding side, and private funding including company and other pensions, including public sector as well, this is an area that was definitely under focus, particularly with the spring budget in 2023. We saw a lot of changes there in terms of the lifetime allowance being changed, the annual allowance. Initially, with the caveat being that this was to help NHS workers in particular and to retain staff, Rachel Reeves explicitly said the day after that budget that she would look to reverse the changes with protection for NHS workers, but not for the wider public. Since then, interestingly, the manifesto has been quite silent on that, and I think the lifetime allowance and the removal of that was actually more complicated to implement than expected. So we do feel now that certainly at least the short to medium term, the lifetime allowance changes probably will not be reversed, but we think it could be quite easy to focus on the annual allowance and other changes potentially, even including around death benefits and pensions, which have been generous in more recent years. Annual allowances could be changed in theory as soon as an autumn statement or a budget next year, as it doesn't require the same level of legislation as the lifetime allowance change. So that's certainly something we're talking to clients about. If they're intending funding pensions or reviewing their pensions anyway, certainly consider whether there could be some changes in the short term in the autumn. In terms of a reduction in interest rates, this is an area that we get asked about quite frequently, in that there's sometimes a perception that a new government, and particularly a relatively stable economy and an expected result in the election, would mean that the inflation rates would result in a reduction in interest rates and obviously people's own personal borrowing, mortgages, etc. The Bank of England, the Monetary Policy Committee, the MPC, are obviously independent of any political party or government in power. And when they look at interest rates and decide whether they're going to reduce those, they look at inflation factors, and the key one being the long-term target for CPI, the Consumer Price Index, of 2%. That figure of 2% was reached in May, based on the end of May figures. However, they also look at other measures outside of that, core inflation as they see it. So other goods and services, fuel, food costs, etc. And service inflation in particular, i.e. hospitality, accommodation, those increases are up to about 6%, which would cause some concern for the MPC. Interestingly, when people have said about governments and how much impact they have, in actual fact, a recent visitor to the UK, Taylor Swift, is more likely to have an impact on rates than Keir Starmer or Rachel Reeves. Why, you might ask? It's more largely in relation to service costs, clearly not unique to Taylor Swift, but the Bank of England wants to make sure that before they make any reduction in interest rates, that they're not seeing any pattern of increase in inflation, even if it's outside of the normal CPI. So as such, particularly when it was nearly 6% in May, we wouldn't be automatically expecting that there'd be a reduction when they meet in August. We think that could be later in the year. So unfortunately for consumers, the election is likely to have less of an impact. The economy might feel more stable, but the Bank of England will be quite prudent before they have any initial reduction. So we get asked a lot about what the impact might be of an election on investment markets, and obviously more recently here in the UK. And clearly people are concerned with how it might affect their savings and their pensions and where they're invested. A lot of that we find tends to be noise, really, and historically, UK and globally, elections have rarely had any real impact in terms of seeing any upturn or a negative impact on markets, particularly over the long term. Generally, that can be because a lot of that can be priced in. So particularly with this election, even though it wasn't a complete foregone conclusion, there was certainly an expectation that Labour would have a majority. It's also because their policies, or their stated policies and manifestos, were not divergent either. So that can often help in terms of stability. But even if you look historically, if you look back over 20, 30, 40 years, and you look globally, the events that really have an impact tend to be more unexpected. They can even be events such as the dot-com bubble that we saw in the early noughties after the tech boom, obviously the financial crisis, COVID, Ukraine war. And from a political point of view, Liz Truss's mini budget, but that was quite distinct. That wasn't as a result of an election. Those events I've just mentioned, you particularly see falls in stock markets, even though they may have recovered afterwards, whereas there's no obvious pattern from the point of view of elections, or for that matter, which particular political party has a majority. So we've also looked at data about portfolios to see how they've performed coming up to elections and post-elections. And again, certainly here in the UK, there's no obvious pattern that there is an uplift in terms of returns or otherwise pre or post. So we all like to talk about it quite a lot, particularly in our sector. But for most clients, it's certainly not that they should be making significant changes as a result. Arguably, if Labour do as they say, and Rachel Reeves is very much focused on stability and maintaining prudent fiscal policy, there could be a longer term benefit in terms of the wider economy, but we certainly don't expect to see any major change in the markets as a result of Labour's victory. We sometimes get asked, what would we be advising clients to do as a result of this election? Are there any immediate actions to take? And the short answer in most cases is that there aren't any. Generally speaking, particularly around investments, we'd encourage people not to make any rash decisions or short-term decisions where they think they might benefit as a result of the election. Certainly, history shows us that's not the case. Having said all of that, we do have some concerns that we haven't had sufficient detail in terms of Labour's policies yet. We have concerns that they've inherited a spending plan which the Institute for Fiscal Studies have already said is going to be very difficult to manage, if not impossible. They've been quite critical of that. There will also now be a period within which policies will be reviewed in detail by the OBR. So as such, we're not expecting that there would be an autumn statement or any type of budget until at least September. However, based on what we do know about spending plans and the fact that Rachel Reeves has been keen to stress that she's not looking to make any significant changes or any radical policies, the revenues will need to come from somewhere. They have been adamant, the Labour Party and the Conservatives, during the build-up to the election, that there would be no increases to income tax, national insurance, VAT, etc. So if that is the case, we do think anybody who's reviewing their planning, particularly if they're looking around areas where they get tax relief like pensions, and the allowances are relatively generous at the moment, not to make wholesale changes to their plans, but certainly to review before the autumn statement and consider the timings of when they may make contributions, if it's appropriate to do so. Also, for those who have investment portfolios, at the moment, the capital gains tax regime is quite generous. We have relatively low tax rates compared to historic rates. This is an area that has been looked at in the past couple of years, and we've seen allowances reduced. It wouldn't be unexpected to see an increase in tax rates. Whether that would happen in the autumn statement immediately or in a budget to follow is a different matter. Revenues have to come from somewhere. So I think in summary, we're certainly not suggesting people should make wide sweeping changes to their financial plans, but because we think there are areas that could be under focus, such as capital gains tax, pension tax reliefs, possibly dividend taxes, it's certainly worth reviewing one's planning before then, because some of those areas could be an easier way of raising tax revenues than income tax and others. So it's really plan ahead well before the autumn.